Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Nice to have you back with us. Thanks for tuning in to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from our Wilson Investment Properties headquarters in Silicon Valley. Wilson Investment Properties is the sponsor of this program, where you can go to tomwilsonproperties.com and get this podcast, this broadcast, and also on iTunes and on YouTube for all of our shows over the past 5 years. If you can't, so that's what you can go to if you can't catch the live show. And also on tomwilsonproperties.com, you can sign up to a weekly newsletter. And by so doing, you also establish a relationship with Wilson Investment Properties, which is where we offer most of our commercial and multifamily syndications, where you can own shares for $50,000 a share and be an investor in large products throughout the country that normally only large investors and institutional investors can get access to it. We doing our program today on the industrial asset segment, asset class of the general commercial class of real estate investing. And we have with us here in studio Mike Priolo, who is the Director of Business Development at Wilson Investment Properties, and he's 12 years experience in commercial real estate, and we're glad to have him with us, helping me co-host with Steve Fithian, who is calling in from Dallas. Steve is a longtime associate, done many deals with Steve. He's a 4-decade real estate investor as well as broker. I always like it when you have professionals in the business who are also investors. It's the only way to get skin in the game is the only way you can really find out, what to do to make the best investments. So he's got many awards for doing great brokerage deals. He's been the past chair of the Fort Worth Commercial Brokers Association, owners of Visions Realty, which is the residential brokerage company, owner also of Frontline Property Management Company and SVN Trinity Commercial Brokerage. Steve has his degree from Claremont McKenna in economics and accounting. And Steve, it's always nice to have you back on the program.
Thank you, Tom. I enjoy it. Mike, hello to you.
Morning, Steve. How are you today?
Great. Doing great. Thanks.
Excellent.
Let's talk about the industrial business. And first of all, I think before we do that, let's define its larger category of commercial. Now, commercial root word is commerce, which means you make money. It's the products that you make money from. And generally, because of the lender market and just the business in general in this arena, even though houses and fourplexes can make money, they're considered to be not commercial, because their primary intent usually is certainly houses is not to be commerce based, even though the hedge funds and a lot of us mid-sized investors have kind of turned it into that in recent years. So within the commercial category, it actually includes multifam. Some people think that it's that apartments is not commercial, but it definitely is. But we generally distinguish between the two, because that's sort of how most people's perspective is. But indeed, multifam is a commercial product because it develops commerce. We love multifam, have bought and own many different products. Right now, they're hard to find that give the same returns as the commercial world. So if they come along, we embrace it. But generally, right now, we find in most markets in the United States that commercial is better. And if you drill that down into office, neighborhood retail, power centers, industrial, warehouse, so forth. Industrial sector is the one that is giving the best returns right now in most of the markets that we look at. And if you go Google for what's the number one asset class that hedge funds and REITs and so forth are looking for these days, you'll find industrial usually pops up on the top of the list. So Steve, with that little introduction for our listeners, why do you feel industrial is giving better returns now, and why do you think that in the recent years it hasn't received as much attention?
I'll go there in just one second. First, I want to just kind of quantify how much better it is doing. Over the past 8 years, industrial properties have produced double-digit total returns, and that's the only property type that can make that claim. And in fact, over the last 12 months, ending in September of 2017, in the industrial market registered a total return of 12.8%. And out of that 12.8%, 7.4% of it was due to appreciation. So it is absolutely clear that the industrial market has been the best performer over the most recent years. Why is that? I think there's a lot of reasons. One would be that just our global economy is very strong. And we, for example, in the Midwest part of the country, there is a lot of industrial properties that are benefiting from global trade, especially if you go down to like the port market of like Houston. Houston has a tremendous amount of incoming and outgoing shipments that go through the industrial market. So the global market is certainly, I think, one attribute that has really made the industrial market bloom. But then also you have e-commerce and kind of some of the trends that are in e-commerce. Of course, what catches the big headlines is the negative impact of e-commerce on a lot of retail. But as far as industrial, it's actually been very positive. Since a lot of the companies are changing their distribution methods, industrial has actually flourished as there's more space in demand, and companies like Amazon are opening huge centers across the country so that they can be closer to their clientele. And then the large companies like Amazon are then generating additional business, if you want to say trickle-down business, with the smaller companies that locate around them. So I would say those are probably the two largest components, is the global trade and then the e-commerce. And then you kind of drill down, and I would say it goes state by state. But for example, Texas specifically, extremely strong economy, and so our distribution market is flourishing. There's other pockets around the country, that can say that as well. For example, I'll single out Ohio and some of the Midwestern area there.
Okay, let's talk about just so people are aware, what is industrial. Let's talk about the different kinds of industrial products, just as a overview, if you will. All
right. Well, you would have bulk distribution, and so, for example, like Amazon, they would use a lot of bulk distribution. So it's mainly just a huge warehouse where goods are stored. But there's state-of-the-art machinery around that, everything, and some of these have robots, very high ceiling heights, so that they can stack goods up even into 30-foot high or so. So you've got distribution, you have manufacturing, you have warehouse space, and what I'll call office warehouse. So especially when you get down kind of in the B product and the C product, there's a lot of office warehouse that would have everything from a landscaping company, an HVAC company, just all the myriad of all these smaller businesses that are out there that maybe they obviously have to have an office, but the office component is a smaller portion. They need to have warehouse, whether it's has forklifts inside, they're storing trucks, they've got goods, So office warehouse that's really been something that I personally focus on, and more of the B product type is what I'm focusing on specifically. And then there's some new industries that have been spawned. I mean, marijuana greenhouses, and for example, in Colorado, and now I'm sure they'll be popping up in California if they haven't already. But that's obviously just in states that are allowing that. The legislation allows it.
Okay, Mike, how would you compare what Steve has said with your more familiar knowledge of Northern California as far as industrial being popular and giving good returns? Would you say that's you see that similarly here?
Yeah, absolutely. I think as Steve touched on with the big e-commerce companies like Amazon.com, you're seeing a lot more distribution centers being built. For us, that market would be like the Central Valley, like Tracy, Stockton, etc. And then you're also starting to see a surge in demand for urban infill warehouses. So basically, what these e-commerce companies are looking for is the warehouses in the valley, which are very large, is a main distribution center, and then they're trickling down and purchasing warehouses in urban infill locations to help with that next day or same day delivery. So you're definitely seeing an increase in demand for all warehouse space in Northern California right now.
Now, of course, we are the only place that has technology. We got spread around the world. And in fact, there are parts of Texas like Dallas and Austin that have pretty high concentrations of technology. So industrial also encompasses R&D space and server sites, right? So that's a category that is kind of, again, hidden from the public view, but is certainly a critical part of the infrastructure. So.
Yeah, absolutely. I mean, I think R&D space, you have out in the peninsula, for instance, there's a lot of biotech. And so they're taking up a decent amount of R&D space, which is, as you said, a kind of a hybrid of industrial space with some laboratory component to it.
Mm-hmm. Yeah. And we also, in the past, I guess in the kind of moderate time period of internet expansion, we've had a lot of servers go to cheaper real estate places. That's more rural, but now that the timing of the information transfer has become critical more to a lot of things, more than just say Wall Street. The timing is critical. So now we're seeing a lot of servers being built in these relatively expensive urban areas. However, there's not much labor component. So and they stack them up and get the density higher and higher all the time. So we're talking today about the topic of industrial real estate. What's good about it? What's bad? How do we find it? And we're going to ask Steve and Mike many more questions. So stay with us here on Real Estate Radio Power Investing. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Nice to have you with us today. Our topic is industrial, and we've got Steve Fithian, 4-decade investor, syndicator, broker in the Dallas and Texas area, and we've got Mike Priola, who is the Director of Business Development for Wilson Investment Properties, here in studio with us today, who has 12 years experience in the Northern California and Bay Area. So, Steve, let's tackle single tenant versus multi-tenant and industrial. On the surface, most people, I think, aren't very exposed to industrial because it's one of those behind-the-scenes things that doesn't have a household name, and maybe that's why in recent years it hasn't had quite as much demand or chase for it as it does right now. But we like that aspect of it. So on the surface, industrial may seem industrial, but single tenant versus multi-tenant is a whole different world, isn't it?
It definitely is. And just so we can define that just a little bit further, it may seem obvious, but just make sure that the people know. Single tenant means obviously that there's just one tenant in the building, and the entire building is designed and built to accommodate that one single tenant. Whereas a multi-tenant industrial building, you have multiple tenants, whether it be as few as 2 tenants or it could be 50 tenants, all in an industrial park or a large building. The single tenants, you see that, for example, Federal Express, they typically lease a lot of their facilities, and so they would be a single tenant in the building that they occupy. The U.S. government is a single tenant in a lot of buildings. There's a lot of manufacturing companies, oil and gas, just many different companies that even auto-related, some of the auto companies will be tenants, and they'll be in a single tenant building. So the big difference on a multi-tenant industrial, you've got a multitude of tenants, and generally those tenants are coming and going. Frankly, you'll have lease expirations, and then other tenants will be coming in behind them. And whereas on the single tenant, with the one tenant, though, the strength of that tenant is the underwriting on that tenant is just paramount. If you have a single tenant building go vacant, then you're 100% vacant, as opposed to a multi-tenant. You lose one tenant. If there's 4, well, then of course you're at a 25% vacancy. So you really have to underwrite that single tenant very carefully. Whereas in multi-tenant, you are underwriting them, but you're also looking at, well, how does this building, will it attract other tenants? How many different types of tenants can be accommodated in this type of a building? So anyway, those are some of the basic differences between single tenant and multi-tenant.
And maybe let's talk about maybe the length of leases, right? And multi-tenant, if you get an average of 3-year leases, that's probably okay. And there's some analogy to multifam. You certainly generally have better quality tenants than you do in a multifam, and you've got longer leases, but nothing like a single tenant, which can be as much as 15 years or more, right?
That's correct. And so a single tenant lease, it might be 10 or 15 years. It would probably have maybe 2 or 3 5-year options after that. They would typically have some bumps in the lease since the lease is going on for such a long period of time. But that lease will be set. There will be some rate, that's set over that term, even including if it has bumps. The bumps are typically defined. Whereas, like you're saying, on the multi-tenant, generically, they're typically shorter-term leases, 3, 5, 7 years. So one benefit on the multi-tenant is that you do have the ability to increase rents more frequently than if you have, for example, a 15-year single-tenant lease. But, of course, you do have typically more turnover because you have a multitude of tenants.
Mm-hmm. Would you say maybe that the multi-tenant is a little bit more susceptible to up and down market cycles, whereas a single tenant provides more stability over cycles as long as they don't go bankrupt?
That is correct, but the single tenant trades at a much lower cap rate. So the multi-tenant, which you're saying can be, a little bit more swings, you are compensated by a higher cap rate for that.
Okay, all right. We're talking about the topic of industrial today. We're going to ask Steve and Mike about what they see in the near future for this particular market asset type. And so stay with us here on Real Estate Radio Power Investing. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We're talking about the industrial asset class right now, part of commercial, and we have Mike Priola in the studio and Steve Fithian in Dallas. both experience in this arena. Mike, would you say you see any differences here in Northern Cal from what Steve just indicated as far as length of leases and single versus multi-tenant? You see pretty similar situation here?
Yeah, I would say it's pretty much parallel, very, very similar to what Steve described.
Now, one of your business models in the past was getting clients to understand that if they sold a relatively low cap rate product here like a multifam, that they could go into a single tenant somewhere else in the country like a Texas or someplace and get a lot higher returns, right?
Mm-hmm, absolutely.
So Mike, what did you assist your clients doing, and what do you do to vet a single tenant, which is Steve said is paramount for this, because you're largely investing in the probability of that tenant staying there for that lease, and so how do you do that?
Yeah, absolutely. And as Steve said too, the underwriting of the tenant is absolutely paramount for your client or for you as an investor. Typically, what we would look for, you want to see previous sales. If you have access to that, tax returns are always good. You really want to take a deep dive into their corporate guarantee, the structure of it. Oftentimes, if it happens to be a franchisee, those can have shell corporations, and the guarantee is really not that strong. So you want a couple of things that I would always do is I'd always advocate for my clients to bring in the proper professionals. You really do need to have someone with some accounting background to look at those financials. You also need to have an attorney that can dig in and find pitfalls in the lease. Myself as a broker, I'm good to give you a high level, but there's definitely some components in there that you want to make sure you take a deep dive with, particularly, as I said, the guarantee and the previous sales and tax returns. Steve,
what would you add to that?
I think interviewing the on-site decision makers is very, very important. What Mike just described, that definitely needs to be done. It would always be done. But an example would be you could have a very, very strong company with fantastic sales, but potentially by interviewing the on-site decision makers, you find out that business is so good that they're going to outgrow that facility, say, in 6 months. So if a lease renewal is coming up, you may get wind that there's a good chance that they may not renew just because of they're growing so quickly. So on-site interview of decision makers, I think, is very good. Then also looking what's happening in that immediate area. Again, they may be successful, they may love the building, but if that area is declining in values, if there's heavy crime in the area, if their buildings are being broken into, then that could potentially impact it as well. So, and really both of those things that I just mentioned, that's applicable to multi-tenant as well. It's just far more important when you're dealing with a single tenant or the risk of them leaving and having an empty building.
And that's primarily if the lease renewal is coming up in the near future, right? Whereas my sense is from the experience I've had so far is if you have a single tenant and you've got a long lease and you think the probability of them going bankrupt is very low, then you aren't quite as dependent on the area. They've got usually a large capital investment into that building, and they're probably going to stay as long as they've got labor force there to do the work, and they've got distribution to get the product out of there. Would you agree?
I'd still do the tenant interview, and I would still be looking at what is the future for this building when that tenant moves out. Again, whether they've outgrown it, whether the area, what's the other. So I still think it's important because you do, even if it's a long-term lease, if you're not going to hold it through that period of time, the buyer that you sell it to, they're going to be concerned when that lease rolls.
Okay, thank you. We'll be back with Steve and Mike here in just a few minutes to talk some more about the industrial asset class.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We're talking about Industrial Day with Mike Priolo, Director of Business Development for Wilson Investment Properties, and Steve Fithian with SVN and Visions and Frontline Property Management in Dallas. Right now, we've got both Steve and Wilson Investment Properties sitting in really, really hot economies, probably maybe arguably the hottest in the country, and just going like crazy. Mike, are you seeing any particular kind of new? Is there one kind of industrial building that's being constructed or has more demand than another kind of industrial building here in Northern Cal?
I think that depends on the investor and their appetite. I think, some of the bigger, more institutional investors are definitely going to be going for those large distribution centers that Steve was talking about earlier. I think some of the more aggressive and maybe or progressive investors are going to be looking more towards like the urban infill industrial product type that I think will continue to have demand as e-commerce continues to dominate the retail sector.
Steve, how do you think industrial asset class fares in up and down market cycles compared to, say, multifam or office?
Well, all of the product types in a down economy are going to suffer. On the multifamily side, you often have tenants that will move back at home, or they'll double up and bring in a roommate or two or three, so the occupancy can decrease. And multifamily side, likewise on retail, especially your smaller mom and pop companies, if they don't a lot of times have a lot of holding power, so your grocery stores and your major tenants will typically survive a downturn, but sometimes again the occupancies come down with your smaller retail tenants. It's the same in industrial, and so if you bought a multi-tenant deal that was a B or a C quality deal, and so you have a lot of these smaller companies, you got rewarded by having a higher cap rate on the acquisition, and you get rewarded as far as being able to increase rents more frequently due to the short-term leases. But during a down economy, you can suffer with some occupancies. But looking in the DFW area at just like the down economies and, how low did the average occupancy get, the industrial cycle typically fares very, very well in comparison with the other product types.
Okay. And
could I go back just to a question that you asked Mike just
Sure.
for a second? Or okay.
Mm-hmm. Sure.
In our DFW area, all of the new construction is focused on the large distribution buildings, 750,000 square feet up to 2.5 million. But yet all of the businesses are expanding, and so it's really leaving a gap for those smaller tenants because nobody is building that type of building.
Mm-hmm. Mm-hmm. Okay. So there's sort of like Class A is the only thing that developers have been building in the multifam arena, and that's kind of gotten saturated. But the ones a step down in size or class are have doing pretty good absorption. Right?
That's correct, and so it is very similar to the multifamily as far as the construction, because same on the multifamily, they're producing Class A, but nobody is doing B or C's.
Mm-hmm. And this whole e-commerce, subject that's in almost every headline across the board, certainly has, in some cases, it's a real problem. We've all heard the stories about how a third of all malls will probably close if they don't get smart enough and have the capital to repurpose and that sort of thing. But we've with the industrial sector. What I think we're experiencing is you got the smaller multi-tenant with the mom and pop shops, but most of those services are still required, whether there's e-commerce or not. You still even if you got the internet access to buy stuff, you still need somebody to manufacture, whether it's windows to retrofit in your house or whether it's the filter material that goes into your home furnace or what it is. That stuff still's got to be made somewhere and distributed. So I think there are a lot of aspects of industrial that behind the scenes are still essential supply chain products that still need to be manufactured. And I think that's good for our American economy too, don't you, Steve?
Definitely.
Yeah, I like that. Steve, why don't you, in the couple of minutes we have in this last main sector, why don't you talk a little bit about where you think the industrial market is going here in the next year or two?
Well, I'm looking at a report from Integra Realty Resources, which is a national appraisal firm, the largest national appraisal firm. And just across the country, they are projecting a 2.64% increase in market rents in traditional industrial properties in 2018. And now, again, they would break that down by different areas, but that's a very healthy one-year increase in rental values. And then they're also predicting that 62% of the industrial markets across the country will have asset value growth in 2018 at 2% or over. So just very bullish in the near term in 2018. And then just personally, my expectation is that what we're seeing on the industrial side is going to continue indefinitely, just again due to some of the structural changes that we've talked about in our economy.
Mm-hmm. Okay. Mike, what do you think Silicon Valley and San Francisco?
I'm sorry.
As far as how strong the market will continue to be in the next year?
Yeah, I don't see industrial going anywhere. I think San Francisco and the San Francisco Bay Area itself is a very unique market, and I think most investors in analytics that I've read are very bullish for industrial as well.
Mm-hmm. And that's why we still see that at the top of the sought-after list for large institutional money, and I think there's a good position for us kind of medium-sized investors to get that product that's maybe just touching or just under what those big groups are chasing. So we'll be back with a little recap here on the whole industrial asset class with Steve and Mike here in just a moment.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
You know, the topic we're talking about today is industrial is one of those that's just not even on the radar screen for a lot of investors. One, they feel like it's something they don't know anything about, which is probably true. So they need a syndicator or brokers who understand that. But it's pretty, from an investor standpoint, I think it's a pretty exciting area. Steve, can you give us a little summary, wrap up of what we've covered?
I personally like all of the major food groups. I like apartments. I like retail, office. I like industrial. But personally, right now, my focus is on industrial due to what we've already been talking about as far as the cycle in the market and then what's happening in our global economy and what's happening with e-commerce. So I will continue to own all four product types. But for this point right now, for acquisitions, I'm focusing on industrial.
Mm-hmm. Okay. And can you expand on that a little bit more about why and what you're looking for in particular? Do you like multifam better than single tenant, or do you like both? Okay.
Yeah, I'm looking for return. And then personally, I do favor the multi-tenant more because I've owned multi-tenant industrial before, and even though there's moving parts with tenants coming and going, we've always been able to backfill the spaces when they've vacated, and in a lot of cases we've been able to get higher rents. So I personally favor the multi-tenant side of it just because I've been able to achieve a higher cap rate. And even though, quote, the risk is there, I haven't really seen the risk from the turnover cost. So my favorite is multi-tenant industrial. I'm actively pursuing it, and I really feel that over the horizon of, say, the next 4 to 10 years, that's going to be a great product type to pursue.
Wow, that's a nice projection, isn't it? I was just yesterday at a presentation where we had some major economists there, and they were pretty bullish on things in general coming up, and industrial was certainly one of those top ones. Mike, you want a few seconds here to round up any other thought you have?
Yeah, sure. I mean, I think for the San Francisco Bay Area, as an investor, you can make an argument for all the asset classes, just depending on what your individual goals are. But if you are looking for return and for some, just some solid performance in the near future, I definitely think industrial is something that you should take a look at and read up on.
And just in general, I've lived in Silicon Valley now for 49 years. I love it here. We've done it's made wonderful contributions to the world. But because of that, there's huge demands that have driven up prices, and rents never go up in proportion with prices. So it's very tough to find the returns here. So that's why, even though we live here and like it, Mike and I do, we love investing in places like Texas, where the returns are higher, employment growth is very high, and I think industrial has a great future indeed. So, Steve, thank you for joining us today again, and Mike, for being here with us to talk about this topic. Again, you can go to TomWilsonProperties.com for this broadcast and all of our other podcasts in the recent years. And also to sign up for our newsletter, though. We get you a weekly letter on what's going on in real estate and economics, and also get you access to syndications, including in the industrial sector. So thanks for being with us on Real Estate Radio Power Investing. And remember, the only thing that matters is what you do next.